dominance of global tech giants like Apple, Amazon, Facebook and Google has been nothing short of awe-inspiring as they piled on stock market gains and rallied on through the pandemic. Even back home, along with pharma, the Indian IT sector is being seen as a beneficiary of the accelerated digital transformation in a post-pandemic world. While there are some headwinds, the outlook remains positive on the back of improving deal activity and sustained cost control. The new rules of customer engagement, the future of work, digital governance, all present an opportunity that the IT sector can capitalize on. Reema Tendulkar is here with a comprehensive look at how the IT sector has been gearing up for the challenges and opportunities that lie ahead.
COVID has resulted in an accelerated move towards digital transformation across enterprises. There is now an increased level of technology adoption around collaboration, cybersecurity, as well as cloud. Work from anywhere has lowered any objections for outsourcing and offshoring that CIOs may have had earlier. So technology is no longer seen as a cost, but more as a business enabler. So if that is the case, can we see higher growth rates for IT companies going ahead? Now, the chart here will show you that growth rates were largely in the mid to high single digits for most companies from FY15 to FY20. FY21, on expected lines, will see a sharp drop on account of COVID. But thereafter, the recovery is going to be quite sharp. So on your screen are Macquarie's estimates. And take a look at Infosys in particular, the blue line. Growth rate averaged about 7 to 9% from FY16 to FY20, and that will accelerate to 11.7% in FY22 to 12% in FY23, according to Macquarie. And for HCL Technology, we're talking about a growth rate of nearly 13.7%. Management commentary has also been quite upbeat. They've said COVID impact will bottom out in Q1. Growth will come back in the September quarter. In fact, HCL Technology in its mid-quarter guidance is talking about a 3.5% revenue growth rate in Q3, margins expanding to 20.5 to 21%. Most companies have also spoken about a strong order win as well as a strong order pipeline. For Infosys in particular, the deal pipeline is now at record levels. Let's move on to margins then. Now, Q1 FY21 had significant cost savings. No salary increments, there was a hiring freeze, and there were no travel costs. If some of these cost savings can be structural, Macquarie estimates that margins could expand by 70 to 130 basis points. Also, a successful execution of this whole work-from-home protocol can further boost offshoring, which provides a margin tailwind. So what can spoil the party for IT companies then? For one, it's the sharp INR appreciation. A 1% fluctuation in the USD INR rate can impact margins by 20 to 30 basis points. And then there is also a possibility of a slow recovery in developed markets as COVID cases continue to rise. Also, bear in mind that valuations today are much higher than the historical levels. Blue lines are the ones which are the current valuations, while yellow is the historical valuations. And you would see across the board, valuations today are higher than historical levels. So some big questions that we're raising today are IT valuations punchy? And if growth rate is going to recover, the question is the recovery in growth structural or cyclical? And if it is structural, and if IT companies are going to see higher growth rates going ahead, let's assume they hit double-digit growth rates for the next few years, can it command higher valuations?
Well, those are all important questions that you're raising, Reema. Many thanks for joining us. And to help us answer some of those questions, we're joined by the man of the moment, Rajesh Gopinathan, the CEO and Managing Director at TCS. Rajesh, many thanks for joining us here on the Global Dialogues. Appreciate your time. At the very outset, I want to caveat the conversation. TCS is in its silent period, so Rajesh will be constrained to give us an outlook for the near term and the short term. So this is going to be a little bit more big picture. Rajesh, let me start by asking you, I can see that you're back at work and I believe that you're coming into work for a few times a day. What do you believe are the structural shifts that we are likely to see as far as the IT services business is concerned? How do you believe the model is likely to change in the context of this new normal that everyone is talking about, in the context of this new work from home and the future of work environment that everyone is talking about? What do you see as the structural shifts?
Shereen, first of all, good evening, and I hope that you and your team and everyone is staying safe in this current environment. Like you said, the whole shift that we're going to see is going to touch almost every dimension And structurally itself, it is going to touch every dimension. If you think about it, starting from a customer side of it, the relevance of technology in the customer's value cycle has never been higher, and it will continue to keep on going higher. And many people have spoken about it, that the impact of COVID has been to accelerate this technology transformation, digital transformation journey that many companies and many industries were on. That's one huge structural impact. There is another one that we have spoken about. We have taken a leadership stance on it, what we call the 25 by 25 model, which is that remote working and collaborative working models will go to another dimension completely. Like you said, the future of work will involve a seamless interplay between locations. It's not about work from home or work from office, but how do you merge the two together into a dynamic one? It'll have implications on talent and learning. So every dimension of it, customer, employee, partnerships and ecosystems, every single dimension is likely to get impacted in a very, very significant way.
Yes, you're right in pointing that out, that every aspect of the business and the business model is going to be impacted. I will focus a little bit more on that 25-25 model that you've put in place, Rajesh, in just a second. But let me ask you then, if you say that we are likely to see all of these structural shifts and these big transitions being made, what will it mean for the industry? What will it mean for a company like yours in terms of growth? Because as Reema was pointing out, between FY16 and now, we've seen growth hovering at under 10%. What could this possibly mean in terms of spends, in terms of growth itself for the business?
Shereen, without giving a specific number, I think we are at the cusp of a significant growth phase for the industry. We have been speaking about this architectural shift that the industry is going through once more, that technology is going through once more. What the events of the last 6 months have done is they have accelerated the shift in terms of at least acceptability of the shift and changed the threshold by which the business cases for the shift were being considered. So far, it is not that the technologies did not exist, but the shift to cloud and the business case for a shift to cloud did not factor in the aspect of risk and resilience. What COVID has done is it has highlighted the value of that resilience. It has highlighted the downside of that risk, so that the business cases have now suddenly become being looked at in a very different way. And this kind of architectural shift is likely to probably last for a few years, because we will see this happening in phases. The first phase is to improve the resilience of the infrastructure and to switch to what we call the digital core. And that is the immediate opportunity. But the Horizon 2 and Horizon 3 are even more attractive. That is, once we are done the shift, we actually will go through a phase of significant transformation at the application level and at the business model and business process level, which will use the native capabilities of this new architecture and new infrastructure more fully. So that will come over the next 18 to months or so. So we are going to have a few waves of significant change happening. And we are at the start of a very exciting phase of transformation.
Okay, so you're saying that we're going to see a few waves of transformation. We're at the start of one wave, and you believe that this is going to play itself out over the next 18 to 24 months. I want to pick up on the comment that you made that we are on the cusp of seeing a significant improvement in growth. Give me a little bit of color. I'm not asking you to tell me what the next quarter is going to look like, Rajesh, but since you pointed out that we're likely to be in this transition phase over the next 18 to 24 months, what could that translate into then in terms of the kind of growth that we could see?
Shereen, I'll not give numbers, so no point in us bouncing on that. But in terms of more qualitative color to it, if you look at what's happening, and in the beginning of the program, you mentioned about many of the technology companies that are at the forefront. A lot of the appeal of this is companies moving workloads to the cloud. But that in itself does not significantly unlock business value. The business value will get unlocked when we actually make the digital transformation at the application layer and at the business utility layer. And that is going to require investment in technology. And that's where the growth opportunity comes. This comes in waves in our industry. It is not the first time it is happening. It happened earlier in web technologies. Later, it happened in mobile technologies. Now it's happening on the cloud and digital transformation layer. And that will then unlock further on the automation side of it. So I don't want to quantify it, but remember that in this industry is still significantly fragmented. And there is a shift towards greater and greater scale in both on the cloud side as well as on the solution side, and that is where the opportunity lies. The companies that are able to maximize that value creation will definitely participate in significant growth.
Okay. I know I'm going to struggle to get numbers from you, Rajesh, but let me pick up on some of the other interesting things that you just spoke of. And let's start by talking about investments. You talked about the need to invest in building tech capabilities. Now, specifically from a TCS perspective, help me understand what that could mean. What kind of investments are we talking about? Which are the areas that you believe you will need to beef investments in? And is this largely going to be driven by organic changes and organic growth? Are you also looking at inorganic opportunities to be able to bridge the tech gaps that you foresee?
Shereen, multiple dimensions on which we are acting on this. On one side, let me address what I said about cloud, which is the here and now immediate change that is happening. To put it in perspective, I would say that cloud is the new ERP. The cloud platforms will be what the ERP platforms were in the decade past. And we are significantly aligning our organization and services around these mega cloud platforms, because we believe that post this initial burst of migration, there will be a lot more of functionality and capability that is natively deployed on these platforms. And we are significantly aligning ourselves to be able to participate in that. So that's one big shift that's happening. The other big shift is what we have always spoken about, which is the value of contextual knowledge. Because what is it that the company currently has? What does our client currently have? And how do we use that to differentiate their solution is going to be big. So we have significantly invested in programs internally to both identify, nurture, and expand that knowledge. We have just finished the first phase of that program, where we rolled out what we call identified 10,000 contextual masters. These are tenured TCSers who have had significant time with individual companies and individual customers and industries. And we have actually identified them, and we are structuring and nurturing that talent, because this will be of significant value to customers as they go about this growth and transformation. Investment in innovation and intellectual assets will be another big element of this shift, both in terms of our work that we're doing on the patent side of it, as well as we are trying to establish that innovation culture across the organization. So we have also invested in opening what we call our PACE ports, which are these innovation labs globally. We launched one in New York, one in Tokyo. We have got another one going in Amsterdam, Toronto, and 6-7 of these will come up all over the world, because these will be the places where we'll do joint collaboration with customers and test out and accelerate that innovation ecosystem. So investments across the whole value chain to be able to fully exploit the power of the technology transformation that is currently going on.
Okay. So Rajesh, between investing in talent, investing in patents, innovation, setting up innovation labs across different geographies, give me some indication of the kind of spends we're talking about. What is it that you're going to be spending? What kind of investments are you going to be making over the next 18 to 24 months?
Shereen, once again, I will not quantify the investment spend, but the changes that you're doing on the services side, the first one that I said, will touch more than almost 30% of the company's service delivery capability. So that's the extent of the shift that's happening there. Similarly, the Contextual Masters program, as I said, has hit 10,000, and it will go where the next target is to go take it to 50,000. So these are very meaningful investments at a company level. Even areas like customer outreach. In the last 3 to 4 months, we have been conducting what we call innovation forums. We have conducted 8 of these. And the outreach has been to more than 3,000 client executives, and very senior level executive participation. So it's a very organization-wide, broad-based shift that we are going through, which will touch every aspect of the organization.
And 30% of the workforce, so that should give us an indication of the kind of spends that we could be talking about. But Rajesh, one of the other points that that begs some attention is what all of these changes, and you pointed out that these are all going to be significant changes, material changes, could mean in terms of the change as far as the margin picture is concerned. I don't want you to give me a number, but I want to understand what kind of tailwinds do you believe that we could expect the margins to benefit from on the back of some of these changes that you've spoken of, and also how the offshore-onshore mix is likely to change in this new world?
Shereen, the best thing that is currently going on is what we call a flight to quality. A lot of our core strengths, whether it is investments in these areas that I spoke about, as well as its manifest outcomes in the quality of the services that we deliver, or the resilience of the organization structure that we have. In times of stable operations, these tend to get undervalued. In these times, their true value surfaces, and clients are shifting more and more towards valuing that quality. So that itself provides a huge support on the margin side. Our ability to participate more and more in the business value chain and to be partners in the growth and transformation space with our customers actually unlocks significantly more attractive service areas. So I'm quite confident on what we had originally said. At the peak of the crisis, we had put out saying that we believe that we'll get margin recovery by the time we get to Q4. We are quite strong on that trajectory, and I'm quite confident that we'll be back there. And into the medium term also, just the nature of the demand and the nature of the opportunity should put us in a very stable margin space.
You're talking about margin recovery by Q4, Rajesh, but do you believe that, at least in the medium to long term, we could be looking at a significantly higher margin for the industry per se, given the changes that you're seeing?
I don't think so. I think we are in a stable margin space. As I said, these changes also need to be seen in the context of periodic cycles in our industry. This is not the first technology transformation cycle, neither will it be the last. So the periods of change involve investment and then reaping from it. And we believe that what delivers margin is your competitive position. And our competitive position in the industry is quite strong and stable. So I'm looking at stable margins rather than margin expansions.
Okay, stable margins rather than margin expansion. You talked about competition. You also talked about the flight to quality. Rajesh, given what we are seeing today and the need for most companies to move and pivot faster towards digital transformation, are you finding it easier to mine new clients or existing clients? Are they being mined for higher dollars? What is that picture looking like at this point in time?
These 6 months are not obviously the right baseline to look at, but a significant amount of traction with our existing client base as well as new customer base, especially in relatively underpenetrated geographies like Europe, continue to be very attractive growth markets for us. And even in our existing client base, there are very large technology upgradation cycles that are getting started off which we are very well positioned to participate in. So overall, both on the existing client side as well as on the new client, in the medium term, we are quite positive. Short term is more volatile, and I think we'll have to just ride out that volatility. But the larger picture is the medium term trends that we're seeing.
Short-term volatility, but positive in the medium to long term. You talked about the large-scale tech upgrades that are on the anvil, Rajesh. Quantify that for us, what that opportunity could mean for the industry. And also, as we move forward and we see more and more companies wanting to adopt digital solutions, is that going to mean a higher spend as well? Do you believe that these large transformation deals that have come the way of Indian IT services companies will become much more of the norm as opposed to the exception?
I do believe so. There are many things that are driving it. One of the big ones is that from a technology side, the CapEx spend is going away from the infrastructure, because what cloud is doing is to transferring that CapEx into an OpEx spend. And that is releasing a significant amount of investment capacity from the customers. So I believe that you will see more and more of capital investment, more and more of investment going into the application stack, into the capability stack, away from the dead infrastructure box per se. And that we have traditionally always participated on the revenue expense side, whereas now we believe that we are likely to start participating more on the investment side also, which is again one of the reasons why that optimism in terms of longer term visibility comes. The other big aspect of it is also, if you think about any industry, the incremental spend, whether it is high or low, the share of technology will always be higher. And that is what gives the baseline for this industry. So quantification-wise, it's difficult. But one way to think about it is that typically on the revenue side, technology spends would be in the range of about 1.5% to 2.5%, other than in industries like banking, where it is much higher. And that used to be split almost evenly between infrastructure and services. So almost half of that is getting released in terms of incremental spend. Some of it will go for cost savings, but a lot of it will also go to finance the increased attention to technology that most industries are seeing.
Well, that gives us some indication of the kind of incremental spends that we could see. What about pricing, Rajesh? And you know, when you spoke in Q1, you said that you were not seeing pricing pressure, the kind that we had seen in 2009. But given the competitive landscape, as we move forward, what do you anticipate the pricing scenario to look like in the medium to long term?
We are seeing very stable pricing environments. And one of the prime reasons for that is, as I said, the consolidation is being driven by a flight to quality. So we're seeing within the context of the deal sizes, we're seeing a very stable pricing environment. And that is in the current space with maximum volatility. And that gives you good confidence about the medium term, when the demand challenges that have been there for the last 6 months start receding. We should see even better supports for the pricing side.
Okay, so stable as far as margins and stable as far as pricing is concerned. Rajesh, I want to pick up on the scale aspect, because you know, you believe that that is going to be one of the key differentiators in dealing with this post-pandemic world and making good the opportunities that will come your way. What will be the levers on the scale front that you hope to deploy?
The biggest lever on the scale front is the capability side of it, Shereen, because the reason why more and more customers are preferring to go with scale providers, whether it is on the cloud infrastructure side or it is on the solution side, is they want to participate in the larger ecosystem of development that is happening. So we are shifting to a mode of what we would best describe as perpetual beta at an organizational technology stack. And to be able to most participate and be in the most innovative side, it is important that the partner who they have is also continuously investing and continuously staying ahead of the curve and having exposure across many. So the advantages of scale will continue to accrue both on the infrastructure and then the services side. And we believe that our relevance to our customers keeps on increasing as we go more and more into an interconnected ecosystem-based structures.
Rajesh, a quick question in terms of people and hiring and what we could expect the medium to long-term trajectory to be when it comes to hiring, given the focus and the enhanced sort of uptake as far as automation, etc. is concerned.
Shereen, you'll remember that in April, when I spoke to you, I said that we are committed that during this period, we are not going to do any layoffs, and we are fully committed to our people, and we are investing more and more in retraining and technology upgradation. We have stayed true to that, but I'm also happy to share that not just have we honored the offers that we have started onboarding many of our outstanding offers. So we have made about 40,000 offers, and in this quarter itself, we'll onboard about 10,000 of those fresh joinees. And I believe that looking into the medium term, the demand for talent is going to continue at pace. And we are quite, so we will be starting our next year's recruitment cycle in October. As you know, we conduct our national entrance examinations. We will be starting that off in the first week of October for digital and the last week of October for our regular hiring. So we are continuing on our talent acquisition mode and continuing to invest and continuing to train to make sure that we are positioned well for the opportunity that we see in front of us.
In 30 seconds, Rajesh, what's the single biggest risk that you foresee for the business?
I believe that the opportunity is real, and the recovery that we're seeing is also real. But we should not get overexcited. We need to be careful because we are not out of the woods yet, both from a health perspective as well as from an economy perspective. And the single biggest risk could be a significant change to the overall health environment that we are seeing. Absence of that, I think we are very well positioned to lead this recovery that is currently gaining momentum and participate in it across all markets globally. So that would be my what I would watch out for.
Rajesh Gopinathan, it's been an absolute pleasure. Many thanks for taking us through the big picture. I know we tried hard to pin you down to numbers, but as I pointed out, TCS in its silent period. But thanks very much for giving us a snapshot of what we should expect, not just for the company, but for the sector going forward. Appreciate your time here on the Global Dialogues. With that, it is time for us to wrap up the CNBC TV18 special. Do stay tuned. There's a lot more coming up.